I'm going to be chatting about the Dividend Aristocrats ETF. But before we get going, we would like to, sorry, I'm just trying to scroll across. We would like to just give you a brief introduction as to some of the background and exactly what is an exchange-traded fund. So an exchange-traded fund, exactly as the name suggests, is a fund which trades on an exchange. Now, that may sound quite simple, but really, and please, if you're a high-tech investor, please bear with us for a few minutes. Really, what it does is it gives you efficient access to a group or a basket of shares. So by simply buying one share, you can get access to multiple shares. The exchange part, I guess, is pretty self-explanatory. It's listed on the JSE, so you can buy it through your EasyEquities brokerage account just like any other normal share. And just like shares, they trade throughout the day. So we as CoreShares are a market maker of these products, which means that we are always standing in the market to give you a fair price in these ETFs. So I'm going to be chatting a lot about ETFs today, and that's really what they are. One important and very crucial aspect of exchange-traded funds is that they are dual regulated, both by the FSB, the Financial Services Board, and the JSE. So that means as an investor, you have comfort that our regulatory bodies are overlooking our investments on a daily basis and making sure that what you see on the box is what you actually get inside the package, or what you see on the fact sheets is actually what's happening in the back end. So that gives you some comfort as an investor as to exactly what you're getting. Another important aspect is that they qualify as tax-free savings investments. So all ETFs, which are collective investment schemes, which is exactly what the Dividend Aristocrats ETF is, qualify as tax-free savings accounts, so you can invest into them for that purpose. Before I carry on, this is a list of various cases for ETFs. Now, I'm not going to sit and bore you through the full laundry list of the pros and cons of ETFs. This is more for informational purposes, but I think some key takeaways from this list are really they're transparent. In other words, you know exactly what you're getting when you invest into these products. They are cost effective, so they're cheap. The specific ETF we're chatting about comes in at a total annual fee of 0.39%. So it's very cheap if you compare that to, let's say, a big active unit trust, which I'm sure you're all aware of the big names, which is you're probably looking at somewhere between 1.5%. So like 1.2% annually cheaper, which really is one of the big benefits and the cases for ETFs. And it's diverse. So you as an investor, especially in the instance of an easy equity investor, when you're doing your own thing, you at least are investing in a basket of shares, and you've got diversification benefits, so you're not exposed to one individual company. So I'm not going to shoot through all those lists. I think let's get chatting about Dividend Aristocrats. So first of all, let's chat a bit about Smart Beta, which is really what Dividend Aristocrats is. Smart Beta is a way of investing, or it's a form of passive asset management where you break the link between a company's size and how much it represents in your portfolio. So in, let's say, for example, a commonly known ETF like the Satrix 40, all they're doing is they're simple, and there's nothing wrong with it, but they're quite simply saying that the biggest company is Naspers, so we're going to give that the biggest percentage of our portfolio. As soon as you break that link between company size and the percentage it represents in your portfolio, you dive into this realm of Smart Beta. And really what it's doing is it's trying to take the best of both worlds. It's trying to say, let's take some of the great attributes of active asset management and some of the great attributes of passive asset management, and let's put them together in one product, like Dividend Aristocrats. So you still, like in all passive products, you've got low cost, you're transparent, and very importantly, it's rules-based, which means that we as CoreShares simply track an index, just like we would just track the top 40. We're tracking the S&P Dividend Aristocrats Index. So that's from the passive aspect. And then from an active perspective, you look at trying to achieve deeper diversification. So like I was chatting about company size and percentage in your portfolio, where Naspers may have 16, 17% of your portfolio. Here we say, hang on, maybe that's not such a good idea from a risk perspective. Maybe there's rules we can build in that try and improve the portfolio from a risk and diversification perspective. And in many instances, like active management, they're outcomes oriented. So here we're trying to achieve a dividend outcome effectively. And then of course the end goal is always to try and achieve better risk adjusted returns. So that's just a little bit of an idea of smart beta and how smart beta works. And the reason why we're chatting about smart beta is because Dividend Aristocrats is most certainly a smart beta product, a smart beta solution. You may have heard other names for smart beta like alternative indexing, but smart beta is what I'll be using when going through this presentation today. So best of both worlds is really what smart beta is all about. And specifically, we're going to be chatting about Dividend Aristocrats. So really, Dividend Aristocrats, the theme or the concept behind Dividend Aristocrats is to say that companies which pay stable growing dividends tend to be good investments over the long term. So this graph, which I've pulled up over here, is some very well-known research done by a guy, Rob Arnott, and it looks at returns over a 200-year period. So we're really looking at long-term returns, but that you tend to get what really drives returns over the long term. And as you can see, of the, let's call it just short of 8% return annually that you got out of the US markets over 200 years, close to 5% of that return actually came from dividend and from the compounding effect of reinvesting your dividends. And the balance of that, in the majority, let's say the next 2.1 odd percent, is made up from two things which relate directly to dividends. So the one thing, they're both dividend growth. One is inflation. So in other words, a company may be able to grow its dividends just by pushing through inflationary pressure onto you as the client. So when you go into Pick and Pay or Spar or whatever, and you're paying more fees or a higher cost for your goods, that's their ability to push inflation pressure through onto you as a customer. So they should get that growth in their dividend when Pick and Pay next announces their dividend. So that's what we call inflationary dividend growth. And as you know, in South Africa, we're trying to manage our inflation somewhere between 3 and 6%. At the moment, it's sitting closer to 6%. So we can think of dividend growth in South Africa at a baseline in terms of companies as somewhere around 6%. And then the real growth is where companies are adding genuine value. They're either growing their revenue or they're making their operations more efficient, and so on and so forth. So that's really where companies are able to grow their dividend over and above the inflation rate to add value to you as the shareholder. And what's really interesting is the change in valuation has added such a small component of long-term returns. So what that means is the concept of buying low and selling high really over long-term investments doesn't add much value on aggregate. So this obviously looks at the whole market. That's not to say that you can't buy a share that's hugely undervalued and it re-rates and becomes fairly valued and then you make a lot of money. But what it shows is that over the whole market and over long periods of time, the ability or the contribution of return from change in valuations is relatively small. So that's really what, some of the background behind dividends and behind dividend investing, which is what Dividend Aristocrats is, and why dividends are so important. So let's have a look at some of the rules how we get to the Dividend Aristocrats portfolio or portfolio of shares which are included in the ETF. Effectively, this index, which the portfolio is based on, so in other words, an index is a calculation done by, in this instance, S&P Dow Jones. They then send us what is in the portfolio, and we go and buy those shares exactly according to those weights. This index's starting point is something called the S&P South Africa Composite Index. So it's the 154 largest shares which trade on the JSE. Once we get to the starting universe, we then look at which shares have paid a stable or growing dividend over the last 7 years. And it must be consecutive 7 years. So in other words, it's looking at absolute dividends. Now, when I talk about absolute dividends, what I'm talking about is cash in the bank. So if, let's say, for example, SAB Miller declares a dividend of R2 today, that dividend must at least maintain at R2 over the next 7 years or grow above R2. If it pulls back at any stage from its last dividend, then it's excluded immediately from the portfolio. So it's really about consistency of dividends and absolute dividends or cash flow. So the focus is on dividends, not on dividend yield. Now, that's an important differentiator, and I'll chat a little bit more about it, but we'll dive into some of the characteristics just now. So we look at all shares which have paid or grown their dividend for the last 7 years, and then once we get those shares, of which there are 31, we then equal weight them. So that's the equal weighting methodology is really a risk tool to say that we don't want to give any single stock too much exposure within a portfolio because of certain risk dynamics that relate to that. So that's in essence the construct of the portfolio. Now, it may sound simple, but sometimes the simplest solutions are some of the best. And I guess the question is, again, I'm not rushing through slides. I'm just touching on some of the high-level important stuff. A lot of the stuff is for your information. I guess before I move on, one important thing is to look at what is the dividend yield. This is a dividend fund, so that is important. The dividend yield is 3.51%. So that relative to like a top 50 is about 0.5% to 60 basis points or 0.6% higher than the top 40. So a relatively good yield pickup. But again, the focus of the fund is not dividend yield, it's on absolute dividends. So what we call quality of dividends. So what are the kind of characteristics you can expect from Dividend Aristocrats, from a share that meets these criteria? So in the indexing world and in the smart beta world, we call this a dividend strategy, which tends to look like a quality strategy. So what we mean by quality, that's relative to a dividend yield strategy, which looks a lot like a value strategy. Now, I'm not going to get into the pros and cons of each, but really, if you meet the criteria of a Dividend Aristocrat, in this instance, it usually shows companies that are profitable, that have great balance sheet strength, that have great cash generative ability. In other words, they always have cash available to pay dividends, and they have management efficiency. So a lot of great qualities are a byproduct of a company that quite simply pays and grows a dividend over long periods of time. So moving on to what kind of companies you can expect to see and would expect to see is a lot of financial companies in this portfolio. So just before I jump into the financials, if I can dive into that category more specifically, you're looking at banks, you're looking at short-term insurers, you're looking at long-term insurers, and then one slight quirk in terms of the classifications is that a company like Remgro, which you'll see, which is effectively a diversified holding company, is counted as a financial, and so is the JSC Group. So they're not, as we would consider, traditional financials. So think about 36% of this portfolio sits in your traditional financial companies like banks, insurers, asset managers. So that's not surprising because of the cash generative ability of these kind of companies. And this tends to play out throughout all markets. Other companies which tend to come out are consumer discretionary companies, consumer staples. So these are your ShopRites, your Spar groups. The kind of companies that tend to be less cyclical. In other words, regardless of what the economy is doing, you need to go to ShopRite and buy your groceries. So they tend to be more stable and have a greater ability to pay dividends throughout all cycles. So that's the kind of companies which you can expect to see in the ETF, and this is the current ETF at present. And we chatted about equal weighting, which was the weighting of the portfolio. So once we get these companies, I'm just going to scroll back. These are the companies which met the 7 years of growing dividends, and that's all great. But then how do we actually weight them in our portfolio? So we look at an equal weighting, and we use an equal weighting methodology. And this slide just shows the impact of equal weighting methodology. So on the left, you've got the FTSE JSE Top 40 Index, which I'm sure you're familiar with. What you can see in a market cap weighting index is you get huge amounts of what we call concentration risk. So that's where, in the instance of NPN, which is the share code for Naspers, you've got a 15.4% holding in one specific company. So that's a lot of your money sitting under one company, one specific risk or a company risk. Then if you look at your top, let's say, 5 holdings, you get close to 40% of your portfolio sitting in 5 shares. So what equal weight looks to do is it looks to say, well, hang on, we don't think that's necessarily prudent from a risk allocation perspective. We think it's probably a better idea to allocate more fairly or an equal contribution to risk and return over all of the portfolio. So you can see the difference in terms of our top 10 holdings, how they look. In fact, at rebalance, our top 31 holdings all have exactly the same weight, versus in a market cap weighted fund where you pick up specific risks and contributions to risk and return, of course. So in the instance of Naspers, which has done really well, that's been great to hold 15.4%. However, if it didn't do so well, like in the instance of Anglos, who used to be 15.4%, and is now 3.4%, that's not so great for your portfolio. So how has this strategy done in South Africa? This is 10-year numbers, which we're showing you, and this is the index performance. So it's not the actual ETF. I'll show the ETF. The index is as S&P calculated, and as I mentioned earlier, we track this index precisely. So in other words, we buy every single share to the exact weighting of the index in this portfolio. And as you can see, the Dividend Aristocrats index and methodology or investing strategy has done really well over 10, 7, 5, and 3 years. Now, this is relative to the top 40, to the SWIX, and another index which I'd like to chat about for a second, because what we found is a lot of clients are comparing them, is the FTSE JSE Dividend Plus Index. You might not know of that index, but I'm sure you've heard of the CoreShares Div, which effectively tracks that index. Now, I was chatting earlier about Dividend Aristocrats being a quality strategy where we're looking at absolute dividends or cash flow of dividends. CoreShares Div is a yield strategy. So yield is a function of two things. It's a function of cash flow or absolute dividends, but it's also a function of price. And when yield increases, it can be two things that make a yield increase. One can be a company that's increasing their dividends, and that's all good. But a yield could also increase because a price has dropped. And in most instances, yields increase because prices drop, or at least yields increase significantly when prices drop significantly. So the CoreShares Div or the Dividend Plus Index is a dividend strategy which is more like a value strategy. So you're buying shares with low prices, whereas the CoreShares Dividend Aristocrats ETF or Div Trax is a quality strategy. So we are more interested in dividends which are sustainable and growing than we are interested in what price we pay for those dividends. And really that's the difference. Ours is a quality strategy. The CoreShares Div or the Dividend Plus Index is a value, looks more like a value strategy. So the returns have been great over all periods. And that's a function of investing in high quality companies, which the blue chip companies, which as I mentioned earlier are profitable, cash generative, efficiently managed, so on and so forth. And they tend to perform really well in these kind of economic environments where there's a flight to safety, or there's a tendency for investors to invest in what we call these dividend aristocrats, or what you would have heard of as blue chip type companies. So a lot of the companies which you would consider blue chip will fall into our strategy as quality companies which tend to be able to perform through cycles. Another interesting stat is that it has a low risk profile from a standard deviation perspective, than the top 40 index. So slightly lower, but not significantly. Now that will be a function of most likely the equal weighting methodology, where we don't have single stock exposures. Another important risk metric to look at, and I'm scrolling back, is the maximum drawdown, which effectively says what's the worst case scenario that's happened while the strategy's run. So the maximum drawdown is effectively, if there are any traders here, you look at tip to trough, or the top of a cycle to the bottom of a cycle. And it is for the Dividend Aristocrats 34%, and that was over the global financial crisis, so the 2008-2009 financial crisis. So that probably doesn't mean much, but if you look at what the all share pulled back over that same period, it was 40%. So you do have some, in addition to the standard deviation, which is effectively how much a share price moves, you do also have downside protection when markets really sell off. So you've got a little bit of a buffer in those instances. The next slide I'm going to show you is just the historic performance of the actual ETF. And again, we're comparing it to the same indices. Important, this is the ETF versus the indexes. So the ETF obviously has costs, it has trading costs, it has an annual fee, which is 0.39. And that's relative. We're comparing this to indexes. So since inception of the ETF, which was April 2014, we've outperformed all our comparable indices and effectively ETFs quite handsomely. This is how we have done as a firm in terms of how we've tracked the index. Now, as you'll appreciate, when we have to go and buy and sell these shares, we incur certain costs. So in other words, let's say we get the index and it says we must buy the shares in the equal weighting, as you saw earlier. We actually have to go and physically buy those shares. So there is a cost to running these strategies. And that's what we call a drag on performance. And that's been 0.8%, which is reducing over time as the fund gets bigger, because the bigger the fund, the more efficient it tends to be from a costs perspective. So the line graph above shows the index versus CoreShares Div Trax. So as you can see, we pretty much track the index identically with a tracking error of 0.5% since inception. And below is the performance that you would have experienced as an investor relative to the index. So as this fund gets bigger, and the fund's just got up to about 100 million rand now, as it gets bigger to 200, 500, a billion rand fund, you'll see that historic performance get closer and closer to effectively the TER, which is that 0.39% I was chatting about. So over the long term as an investor, you can expect to get the index less around 0.4% for costs and the cost of implementing it and the asset management fees. So the one question, I guess, is how does this look from a risk and return perspective? Now, without getting too technical, a measure that's used in the asset management and in the investing world is something called the Sharpe ratio, which just measures your risk relative to, or your return relative to the risk you're taking. So if you're taking huge amounts of risk and getting decent return, that's going to show poorly in a Sharpe ratio measure. So this just shows that over rolling periods, in other words, if you look at cycles, 5-year cycles, starting in 2008, so like a 2008 5-year rolling return would be back to 2003, 2009 would be back to 2004. So over pretty much every possible cycle, this strategy actually outperforms the top 40, the top 40 index. So what that means on a risk-adjusted basis, you're getting better returns, and on a return basis, excepting for the 2009 rolling period, where what happened with the global financial crisis is the financial stocks tended to sell off before the other stocks. So in other words, the return dropped before the rest of the market in this particular strategy. But otherwise, over 7 of 8 periods, you're going to get a better risk-adjusted return, well, certainly historically. Now, obviously, that's not a predictor of future returns, but that just gives you an idea of the kind of performance that you can expect relative to risk over long periods of time. So that's that's all from us at CoreShares. Thanks again to the EasyEquity guys, to Josh and his team for hosting us today. And thanks to you, the listeners, for tuning in. We really encourage questions, and if you have any suggestions or recommendations how to make our webinars any better. For you traders, the share code for this ETF is DIVTRX or Div Trax, and it's obviously immediately available to invest in. So I'm just going to have a look if there are any questions, and if you do have any questions, please feel free to ask. I may have to ask some of my colleagues to read them out because I'm sitting far from the screen. We've got quite a few. If you don't mind giving me a second to try and collate these questions, and then we'll respond to them as soon as possible. Yeah. All right, we've got a few questions. The fact sheet is available on our website. That's on www.coreshares.coza, and I believe, Josh, correct me if I'm right, but the EasyEquity guys just did a write-up on EasyEquities.coza about the Dividend Aristocrats ETF. So there's some information there, and of course, feel free to contact us. All our contact details are on our website. Or you can email us at info@coreshares.coza.
The question about the weighting.
Okay.
So the fact sheet on the website lists the weighting of the shares in the ETF ranging from 2.75 from the price to 0.98 for Bidvest.
Okay.
Have you since sold and bought them to get back to the same weighting?
Yeah. So we've got a question about the weightings. So what happens with an equal weighting methodology is they are reweighted quarterly. And on that quarterly reweight, those will be exactly equally weighted as the name suggests. However, over that quarter, shares can drift. So in other words, if a share performs really well, its weighting, let's assume the weighting was just 5% per share over at the quarterly reweight. If that share does a 50% return, its weighting may move up to 7.5% or even higher. And if a share's decrease or in other words has had negative returns, its weighting will decrease. So the weightings drift over the quarter, and then we reweight at the quarter end. What happens is that, and it's one of the equal weight methodology attributes, is that what you tend to do is sell when you sell your profits, and then you're buying shares cheaper as they've dropped off in price. So it's one of the equal weighting methodology quirks. But weightings will drift through the quarter, so you will see with specific reference to the Bidvest transaction, there was a corporate action and an unbundling. So there was some, as you'll appreciate, at the fund level when we're managing, there are some instances where, like Bidvest unbundles, where the weighting may seem quite strange because of such, and that will generally be brought back into equal weight at the end of the quarter.
So the next question is there any premium an investor pays over and above what is normally paid for other non-smart
beta ETFs? So smart beta tends to come with a slightly higher fee. Our total expense ratio on this fund is 0.39%. Now, where you've got to be careful is just assuming that another ordinary ETF, as you put it, or market cap weighted ETF would be cheaper. There certainly are market cap weighted ETFs on the JSE that are cheaper. For example, our CoreShares Top 50 we have a headline service charge of 0.2%. So we expect a TER of, let's say, 0.25%. And smart beta does tend to be slightly expensive, but I would encourage you as investors not to use that assumption. There are, like, let's say, for example, top 40 ETFs in the country, which are more expensive than our smart beta strategies. So it's not an all-encompassing rule, but smart beta tends to be slightly more expensive than what we would call vanilla beta or market cap weighted beta. And that has to do with that whole in-between of active and passive, where you've got some rules and you've got some intellectual property or overlay of strategy relative to just a market cap weighted fund.
Will you have the trade-off of potentially giving up possible greater growth of the actual share against the security of receiving a dividend? For example, when one compares a mid-cap ETF versus CoreShares ETF, the mid-cap ETF might not have the best dividend payments, but potentially has a greater possible growth of the actual value of the share.
Okay, so we've got a question that looks at, I guess, different investing strategies. Really, you're looking at one where you've got a growth, and you reference specifically to the mid-cap ETF or a mid-cap strategy. Remember, that's got two components. It may have a slight growth component because the dividends are low and you're going to get more out of the growth in the company, or if they're reinvesting their capital into the company. But you're also looking at a big size factor. So in other words, you're investing in much smaller companies, and that's the whole mid-cap philosophy really is it's a size factor. So what that means is smaller companies tend to outperform larger companies over long periods of time. And that has to do with larger companies being more mature and being less able to find these sort of astronomical growth rates that smaller companies can. But when you're investing in Dividend Aristocrats, we look at the whole universe. So if I had to scroll back to that company list, you'll see some relatively small companies or companies that would have been in the mid-cap index anyway. So you're not necessarily giving up on growth. You may argue that a mid-cap index has more growth prospects, and perhaps that may be correct. But a Dividend Aristocrats is not a yield strategy like I was chatting about earlier. It's really a dividend growth strategy because you're looking at sustainability of dividends and you're looking at the ability to grow dividends. So they're two different investment philosophies really. Not one is better than the other, or one is correct and the other incorrect. So I hope I answered your question. I feel I went around in circles a bit there, but if you want to follow up, please feel free. For now, that's all the questions we have. Again, if you've got any questions you want to take offline, and send us an email at info@CoreShares, or get hold of the EasyEquities guys. They'll either answer your questions or get in contact with us. Please feel free. And thanks again for your time. And thanks for tuning into this webinar hosted by EasyEquities.